Look, what's happening right now with gold and the bonds? Why would any country, like, look at China. They used to have almost 3 trillion in treasuries. They're down to just over 700 billion. Why would any country want to hold any of our debt of any duration when this stuff is happening?
As to this recent reaction, I would say that it is perfectly normal. The excessive speculation, perhaps, which is reflected on the Shanghai Futures Exchange, might be behind this move back. There has been a build-up, if you like, in terms of open interest on COMEX as well.
If that's right, you could be talking about a gold price that was $7,000 or $8,000 or $9,000 or $10,000.
In today's episode, 3 financial experts, Rick Rule, Andy Schectman, and Alasdair Macleod, share their insights on the current situation in the gold and silver markets, as gold has broken down again and is now trading below $22.80 after making a fresh weekly low of $22.17. On the other side, Bitcoin is rising more than 4.5%. Stocks also jump and yields fall on hopes U.S. labor tightness ebbing. The second most hated institutional bank on the planet, Goldman Sachs, now prefers commodities and cash amid rising uncertainty. Analysts at Goldman Sachs said in a note that they are shifting to overweight commodities on a 3-month and 12-month time horizon to diversify overheating and geopolitical risk. They are also shifting to overweight cash on a 3-month horizon to reduce portfolio risk. The investment bank notes that the macro backdrop has turned less friendly since March due to higher inflation and upward pressure on rates. Still, their baseline remains friendly for the rest of the year. While our business cycle indicators still point to a late cycle backdrop, those can last a long time, and equities can do well if there is no recession, says Goldman. Are they hedging their bets, or will Goldman be actually right for once? Now we'll show you a compilation of clips of the most sought-after commodities experts, filtering down for you what we think is the most relevant info after watching hours of their interviews, so you don't have to. If you find our videos useful and valuable, smash that subscribe button and turn on notifications. Remember that you can watch their complete interviews, as we always give credits in the description. Nothing but love to everyone talking about the gold and silver markets and helping out the community to gauge a better understanding of precious metals. Now let's get back to the episode. Enjoy the video.
7,560 gold kilobars that were shipped out of the COMEX, okay? That's $571 million worth of gold. 243,054 ounces. Who's got that kind of bread, right? So it was all shipped through to Hong Kong Brinks. The exchange for physical is a way where you can buy a contract on the COMEX and exchange it for physical, typically in London. But if it's done in the OTC market, the over-the-counter, the two participants can negotiate and say, I'll take it here. And they can even negotiate, I believe, in the form of the gold. You want gold eagles? Fine, we'll deliver it there. But anyways, the OTC is, in respect to Brinks in Hong Kong, almost all of the, and this is a COMEX approved vault, right? Almost all of these transactions that go to Hong Kong Brinks are OTC, right? Almost all of them, or excuse me, exchange for physical, almost all of them, right?
Gold is, I think, for the Chinese central banks and for many other central banks, fulfilling its traditional role, both as a medium of exchange and as a store of value. Imagine if you were the Chinese and you ended up with several trillion rubles and you didn't have the ability to spend it on anything from Russia. When it was efficacious for them to denominate their trade in US dollars, they did it, and they did it comfortably for years, and they were for years the largest holders of U.S. treasuries. The relationship between the U.S. government and the Chinese government now probably leaves the Chinese no choice but to reduce their holdings of U.S. treasuries and substitute gold for that asset class.
Bond yields rise, which in recent years, recent decades, has been bad for gold. We've seen the dollar rise on trade weighted, which has been bad for gold. And taking particularly those two together, you would think that gold actually would have fallen, but instead it rose as bond yields rose, and it also rose as the dollar rose. So this is a very, very different time, I think, from anything we have seen since those 1970s. Now, principally, the difference between that sort of period following the 1970s and the 1970s was until interest rates were raised to close to 20% by Paul Volcker, there was a fear in the markets that hyperinflation would take place. In other words, the purchasing power of the dollar and other currencies would decline substantially in this new, it was then a new sort of fiat paradigm, if you like. That was finally broken by the determination of Paul Volcker, as I just said, by raising interest rates. Now, since then, interest rates and bond yields have declined and declined and declined. They've now started rising. The problem with rising interest rates now is that it exposes government debt, it exposes malinvestments, it exposes a lot that's going to go wrong in the world of credit.
The financial landscape is increasingly turbulent, with experts like Alasdair Macleod believing the crisis will worsen. Recent regional bank failures echo the 1970s financial turmoil, highlighting vulnerabilities in today's economic framework and signaling further instability. Amid this uncertainty, gold and silver markets are behaving unexpectedly. Despite typically suppressing factors like rising bond yields and a strong dollar, gold and silver prices have risen, indicating a unique market scenario and potential shift in investor sentiment. Alasdair Macleod points out that China is strategically reducing its reliance on Western currencies and expanding its gold reserves. This long-term policy aims to shield its economy from external shocks, reshape the global economic order, and assert more control over monetary policy. In contrast, the U.S. faces a looming debt crisis. Rising interest rates and a substantial budget deficit stretch finances thin, worsened by reduced demand for U.S. debt, particularly from China. If not addressed, this could lead to a dangerous debt trap and further destabilize the global economy. Now, we'll show you more clips, but remember to subscribe to the channel so you do not miss out our daily videos. Let's get back into the episode.
And so what happens is that you had 243,000 ounces get delivered in the OTC market in exchange for physical to Brinks, Hong Kong. And what happens then is that once the gold arrives in Hong Kong, the trade is unwound in COMEX, and the bars are then transported by armored truck to the Shanghai Gold Exchange. So again, we've been saying this forever. These people are using the suppression of the Western market against us. They short the price on COMEX. They then purchase the physical at a subsidized price and stand for delivery in Hong Kong and then move it to the Shanghai Gold Exchange. The banks, right? Ultimately, I've said for a very, very, very long time that interest rates spike to the moon as people dump our treasures. Well, it's happening. The little by little by little, it's happening. You can see it.
And principally, when it comes to monetary affairs, there are two worlds. There's the world of money, which legally is gold, and there is all the rest, which is credit. So it's that relationship between gold and credit. So what the gold price has been telling us in recent months is that the fear is now about the future of credit, not interest rates, not the exchange rate of the dollar measured in other fiat currencies, which of course is what the trade weighted index is.
The recent strength in gold, and by recent I mean the last 2 years, has been more a function of central bank buying than retail buying, even in China. The Chinese market, and to a lesser extent the Indian market, has seen more retail buying than the US market, which has in fact seen retail selling. But the statistics would suggest that the buyers of gold in real size have been foreign central banks, reacting, I suspect, by the US government's attempt to weaponize the US dollar, whether it is seizing $300 billion worth of Russian holdings of US Treasury securities, which should make any country that holds its wealth in US Treasuries concerned, or the weaponization of the SWIFT banking system by the US to reinforce sanctions. Whether or not, as an American, you agree with those policies or not, they're disquieting to foreign central banks who have suddenly come to understand that denominating all of their foreign currency transactions and their national savings in US dollars and US Treasury securities is not a good thing. With regards to the difference between Chinese buying, that is Chinese retail buying, and US retail buying, the Chinese government has an official policy of encouraging their savers to save, among other things, in gold, which is to.
So this is fundamentally different. Now, to an extent, it has been led by China. The pace of Chinese buying, not just the central bank, but also other Chinese actors, of physical gold has increased. And indeed, we have seen this extraordinary situation whereby Western ETFs have been declining and feeding gold out, as it were, into Asia. Now, this is an extraordinary situation, because what that again tells us is that we in the West have tended to sell gold while it has been going into new high ground. Now, this is the sort of behavior which is temporary, because there does come a point, I'm just purely talking about psychology now, there does come a point where people sort of turn around and say, oh, hold on a minute, gold is in a bull market, bonds are in a bear market, that makes equities less attractive. The only game in town is gold. Therefore, we should, why is it going up? Perhaps we should buy it, sort of thing. So it's a sort of in-between period, if you like, in terms of the psychology of markets in the West.
Dollars, that gold would have to break out above 2,700 to get to new real highs. It's interesting that when people talk about money, they don't talk about money in terms of the constant. And when you talk about gold, you are talking about the constant. So my suggestion would be for gold to take out the old highs, which I think it will do, it would have to go through 2,700. But your bigger point is more important. For me, gold isn't a trading vehicle. For me, gold is a store of wealth, a medium of exchange, liquidity, and insurance. And I own gold because I'm afraid of our incomprehensible debt levels. I own gold because the interest expense of the US government is, I think, and I say the US government, but I could just as well say the EU or Canada, is going to overwhelm our ability to sustain it. I'm old enough, Daniela, that I remember the decade of the 70s. We dealt with it by inflating away the purchasing power of the instrument that the debt was denominated in. Over the course of the decade of the 1980s, the purchasing power, constant purchasing power of the US dollar declined by 80%. I think that sort of thing is precisely what's on offer now. If that's right, and I believe it's right, if that's right, you could be talking about a gold price that was $7,000 or $8,000 or $9,000 or $10,000. Am I saying gold is going to go to $10,000? No, but I'm saying that there is a strong enough possibility of it, and the consequences of that for you maintaining your lifestyle with a US dollar denominated balance sheet would be very unpleasant. So I think that people who are concerned.
Do you think China is coming for your gold and silver? Are you worried about the declining importance of the dollar in the world? Post in the comments section if you think the Chinese strategy to weaponize the paper markets in gold and silver is clever, and if you're buying more gold at these prices. That's it for today. Check this video right here because you'll love it. And I see you on the other side.